Hey everyone, and welcome to a brand new explainer right here on the Gap Advisors Ind AS Clinic YouTube channel. We're jumping straight into a frankly fascinating accounting puzzle today. This analysis comes directly from the 234th edition of the Gap Advisors Task Weekly newsletter, which is brilliantly authored by CA Manish C. Iyer over on LinkedIn. If you ever deal with complex group structures and intragroup sales, you are definitely going to want to stick around for this.
Real quick, before we get into the mechanics, let's cover our standard disclaimer. The views expressed in this explainer are purely the personal views of the author, and they're not binding on anyone. Always make sure to seek out expert help before taking any action or deciding to refrain from any action based on what we discuss here today.
Okay, let's establish some ground rules so we're all on the exact same page. We're operating within the Indian corporate accounting landscape. That means our functional currency and our presentation currency is the Indian rupee. Naturally, any currency other than that functional currency is classified as foreign currency. And our reporting period begins on the 1st of April and ends on the 31st of March. Just keep those standard guardrails in mind as we go.
Here is our agenda for today. First, the scenario. Second, the core accounting queries. Third, impact on B Ltd. Fourth, impact on A Ltd. Fifth, the Ind AS framework. And finally, the Gap Advisors Knowledge Hub. Let's get to it.
Section 1. The scenario. Let's set the stage.
All right, imagine a simple three-tiered corporate structure. At the very top, you have A Ltd, which is an overseas entity following IFRS. They own 100% of B Ltd, an Indian company. In turn, B Ltd owns 100% of C Ltd, which is another overseas entity. Here is the inciting incident. During the 2019-2020 financial year, the company in the middle, B Ltd, sells its entire investment in C Ltd straight up the chain to the ultimate parent, A Ltd. And crucially, they sell it at a loss.
Section 2. The core accounting queries. So what's the actual accounting dilemma here? Well, this intra-group shuffle creates two massive questions for the finance teams. First off, how on earth does B Ltd account for this transaction in its books? And secondly, since B Ltd sold C Ltd at a loss, does that loss just vanish? Is it completely eliminated as a consolidation adjustment when A Ltd prepares its consolidated financial statements?
Section 3. Impact on B Ltd. Let's look exclusively at our middle entity first.
What's wild here is that B Ltd actually has a split accounting personality, depending on which books you're looking at. In their separate financial statements, it's pretty cut and dry. They simply derecognize the investment in C Ltd and recognize that loss in profit or loss. But in their consolidated financial statements, totally different story. Because they lost control of a subsidiary, they have to derecognize all the underlying assets and liabilities of C Ltd, recognize whatever consideration they got, and the difference is treated as a gain or loss. Think about that absolute quirk. A loss in the separate books could literally flip into a gain in the consolidated books, just depending on the carrying amounts of the underlying assets. Crazy, right?
Section 4. Impact on AM Ltd. Now we shift our perspective to the top. For the ultimate parent, A Ltd, the impact of this grand transaction on their consolidated financial statements is exactly zero. Zero impact. Why? Because ultimate control never actually changed hands. A Ltd controlled C Ltd before the transfer indirectly, and they control it directly afterwards. Because of this, any gain or loss that B Ltd recognized gets completely wiped out when A Ltd consolidates the group.
Section 5. The Ind AS framework. Let's back this up with a theory.
For your audit files on B Ltd, you're going to want to cite Ind AS 110, paragraph B98. This paragraph specifically dictates that when a parent loses control, it has to derecognize the assets and liabilities, recognize the fair value of the consideration received, and log any resulting difference as a gain or loss. That proves exactly why B Ltd's consolidated books look the way they do.
And just to be completely thorough here, don't forget about paragraph B99 of Ind AS 110. If there were any amounts sitting in other comprehensive income related to that subsidiary, the parent, so B Ltd, has to account for them exactly as if they directly disposed of those related assets or liabilities. This generally forces a reclassification adjustment straight from equity into profit or loss. Now, what about the ultimate parent, A Ltd? For them, we lean on paragraph B86 of Ind AS 110. This is the bedrock of consolidation. It says you combine like items, offset the investment, and most importantly, you eliminate in full all intragroup assets, liabilities, equity, income, and expenses. Because this was strictly an internal family transaction, the resulting profits or losses are wiped out entirely.
But wait, there is a massive caveat hiding in the text of paragraph B86 that you absolutely cannot ignore. The standard explicitly warns us that an intragroup loss might actually indicate an impairment. Sure, you eliminate the artificial loss between the companies, but if C Ltd's underlying value is genuinely impaired, A Ltd can't just pretend everything is fine. You are very likely going to need an impairment test here.
So, to pull this whole puzzle together, the treatment depends entirely on whose desk you're at. B Ltd's separate books derecognize the investment and recognize the loss. B Ltd's consolidated books run the loss of control accounting, netting a gain or loss difference. A Ltd's consolidated books eliminate the intragroup transaction entirely, like it never even happened.
Section 6. GAAP Advisors Knowledge Hub.
By the way, this fantastic scenario is just one out of over 4,500 issues housed on the GAPadvisors.com issue repository. That's over 4,500 issues in detailed responses specifically on Indian accounting standards and Indian GAAP.
And you can tap into this right now. Anyone can register for free on GAPadvisors.com. Once you're registered, you can submit your own thorny issues on Ind AS and Indian GAAP, and you'll get a highly detailed response sent directly to the email inbox you signed up with. For auditors out there who need rock-solid documentation on exactly how they tackled a tricky Ind AS application, this platform is literally a lifesaver.
Thank you all so much for your time today. If this explainer helped clear things up, please drop a like and add your comments below. And make sure to subscribe to the GAAP Advisors Ind AS Clinic channel if you weren't already subscribed. We'd absolutely love it if you shared this explainer with your contacts, audit and finance teams, colleagues, and especially students pursuing their CA course. Let's spread this knowledge of Indian accounting standards far and wide. Also, remember this issue is featured in the 234th edition of the GAAP Advisors Task Weekly newsletter. With over 230 editions published to date, it's a goldmine. If you're on LinkedIn, go subscribe to that newsletter for free right now. I'm going to leave you with a question to really chew on. If your subsidiary sells an asset internally at a loss, how confident are you that your finance team caught the underlying impairment trigger? It's the kind of question that definitely keeps auditors awake at night. If you want a complete deep dive into this exact issue, head over and connect to our companion GAAP Advisors Ind AS Clinic podcast. You can find it right now on Spotify, Amazon, or YouTube. Thanks again for learning with me today, and I'll catch you in the next explainer.